OpenAI's potential trillion-dollar IPO presents a generational opportunity to invest in the leader of the AI revolution. However, a structural fault line exists, creating a paradox between its non-profit-controlled nature and the profit demands of public markets. The company's meteoric rise is undeniable, with a recent secondary stock sale valuing OpenAI at an astonishing $500 billion. This valuation makes OpenAI the most valuable venture capital-backed startup ever, signaling immense investor appetite. Fueling this hype is rapid revenue growth, with an estimated $12 billion in annualized revenue by July 2025, driven by enterprise adoption. The launch of GPT-5 in August 2025 further solidified its market leadership, with major enterprises like Amgen, BNY Mellon, and Morgan Stanley integrating the new technology. Before any public offering, OpenAI underwent a critical corporate restructuring, shifting from a capped profit model to a public benefit corporation, or PBC. This change was essential for continued expansion, moving away from profit caps and equity limitations, and was a prerequisite for securing a major investment from SoftBank. The new ownership structure of OpenAI Group PBC is complex, balancing commercial goals with its original mission. Microsoft holds a roughly 27% stake in the new for-profit entity, while the original OpenAI Foundation, a nonprofit, retains 26% and controls the for-profit company through its board. The fundamental conflict lies between OpenAI's PBC structure and the relentless profit maximization demands of public markets. The nonprofit board retains ultimate control, legally empowered to override commercial decisions if they conflict with the company's core mission of developing safe and broadly beneficial AGI. This creates a level of uncertainty that most investors are unwilling to tolerate, as public market investors have zero appetite for such existential uncertainty. Sam Altman's brief ousting and reinstatement in late 2023 served as a case study in this governance risk, proving the nonprofit board's willingness to protect its mission. Beyond its structural paradox, OpenAI faces intense competitive, financial, and legal challenges. Microsoft, while a major investor, is also OpenAI's most powerful competitor, using licensed technology for its own Copilot brand and gaining direct access to enterprise customers via Azure. The AI field is crowded with well-funded competitors like Anthropic, Google DeepMind, and Meta, eroding OpenAI's technological moat and creating downward pressure on pricing. The staggering cost of AI dominance is evident in OpenAI's estimated $8 billion cash burn for 2025, forcing the company towards public markets despite its governance structure. OpenAI also navigates a legal and regulatory minefield, including a landmark copyright lawsuit from the New York Times and a lawsuit from Elon Musk. While the hype around an OpenAI IPO is undeniable, a growing chorus of skeptics questions whether the company's valuation is justified by its underlying business model. Some commentators have labeled it, "We work on steroids," or Enron levels of fudging the numbers due to insane capital expenditure and a lack of a proven, cash-generating business model. Despite these risks, CEO Sam Altman confirms an IPO is the most likely path for OpenAI, given its monumental capital needs for achieving artificial general intelligence. This highlights the inherent tension between OpenAI's mission-driven structure and the demands of public markets, making its path to a successful IPO uniquely challenging.